So this company is technically the largest car maker in the world by market cap at over $1.4 trillion, despite only selling about a tenth the amount of cars as Toyota. If you bought 10 years ago, you would have returned over 2,470%, essentially turning a 10K investment into 250K, which is definitely not bad. It's one of the most popular companies in the world and headed by the richest man in the world that most either love or hate. And if you haven't already guessed by now, the company is Tesla. And we're going to strip away the hype and determine what it's worth, how much you should buy it for, and look at all the specific scenarios so that you can make an educated financial decision. The latest vehicle that they came out with was the Tesla Cybertruck, which I don't know. You kind of either love it or hate it. I think it's definitely grown on me, although it does look a little funny looking. But a lot of people seem to love it. And they're also working on developing a Tesla Semi, fully electric semi truck for commercial use. For their 10K, they are focused on bringing artificial intelligence to the real world through products and services like full self-driving, robotaxi, as well as working to develop and commercialize AI robots. It's funny that in here they have a focus on AI robots, but not really mentioning cars. So as far as segments go, we have automotive, energy storage and generation, other, we're including full self-driving, insurance, charging network, robots, and plant for robotaxis, cyber semi, and any other developments that they have going on. And so currently, they primarily make money from their automotive sector. And then next we have the energy storage and generation sector. For the automotive, it's all the cars that they make, the Model S, the Model E, the Model S, the Model E, the X, and the Y. For the energy storage and generation, we have the Tesla Mega Pack. We have the Tesla Power Wall. We also have the Tesla Solar Roof. All pretty cool. We also have robots like Tesla Optimus. Not really in use right now, but it's still a very small industry and one that is expected to grow by quite a bit. So we'll have to see. So we'll have to see how this evolves, but it definitely adds some optionality to things. Probably will become a big business in the future, but I don't have my crystal ball with me at the moment. So we'll just have to see how that works out. But we'll also factor it and keep it in mind when we get to the actual valuation of things. All right, so next, let's look at the risks and opportunities. I would say that the biggest risk of all is probably Elon Musk himself. E-man risk. Something happens to him, then Tesla and all of its related companies are at risk. He is pretty much the face of Tesla, the face of SpaceX, the face of Twitter, Grok, Starlink, all those things. So it's very risky to have all of your eggs in this one basket. I'm sure that there are a lot of smart people working at Tesla that can take over if something does happen to them, but it is definitely a risk nonetheless. Another risk is competition. So we have, whoops. So we have competitors like BYD, Rivian, Polestar, Lucid. And we also have legacy manufacturers like Honda, Ford, Honda, Ford, Volkswagen, Porsche. You see, all developing their own electric cars. We have Toyota with the hybrid. And we also have risk for internal combustion engines, regular old cars. And so another thing to keep in mind when it comes to the risk is that the landscape is getting really, really crowded. You have BYD in China, Rivian domestically, Polestar, Lucid. They're all eating into Tesla's margins, and that's something that we'll see when we actually take a look at the metrics because Tesla's car market might actually be cooked, but they do have other segments that could, propel the growth of the company, and which may actually make it a good company to invest in, a good company to buy, and good company to own for the long term. But we will take a look. All right, and so we have the risk, Elon Musk, competition, market saturation, and there's also another risk, FSD. Been talking about FSD for, I don't know, about 4, 5, maybe 6 years. It's always on the horizon, running into issues. It hasn't been delivered. Where it has been delivered, it's run into snags. And we also have robo taxis. I know that a lot of investors, a lot of current investors with Tesla are expecting robo taxis to just take over. But it's a risk because Waymo already has a huge lead. They already have a huge lead in the market. And so if Tesla wants to make this commercially available, they need to do a lot of catching up. Talking about the risk with the energy and storage, they do compete against utility companies for their energy storage and generation. I'm sure that as that market gets more robust and built out, they'll likely run into more competitors. I know that they have all these segments. Their models are popular. The Cybertruck is popular. Energy storage and generation is growing very fast. We have, a few other nascent industries expected to pop up and grow and contribute to the bottom line, but the case is still out, or the verdict is still out in those cases. And so let's look at the opportunities. So they have a strong brand and IP. They do a lot of vertical integration. They have compute, gigafactories, infrastructure, and their network of chargers. Although I mentioned robo taxis, I know that that's technically a risk because Waymo already has a huge lead. Even though Waymo does have a huge lead, the market is still so small. I think it's only really out in a couple of states, a couple of cities in those couple of states. And so, should it get national recognition, it could just be everywhere. And so, even though they have a huge lead, there's no really dominant player there because the industry is so small. Should their strategy pay off, then there's definitely room for them to go head to head, compete, and increase their market share without diminishing one another's. So, high upside. Then let's also take a look at industry growth. So autos are expected to grow at around 9% annually, according to Markintel. So looking at industry growth for storage and generation, the capacity is expected to grow annually at around 23%. Installations at 30%. So it's definitely a really good industry to be a part of. Still early, still growing, high growth rates. So that is one opportunity. And then for robots, this is a big one. According to ABI research, they are expected to grow at a whopping 130% annually. Again, it's a big number, but because the industry is super small, that's not really a big deal. I mean, sure, it can grow very fast initially, something like this. Where it grows really, really fast and then it kind of levels out. like that. And so we're still kind of right here in this area at the moment. It hasn't really reached mass adoption, and so it's not really a developed industry. So it definitely has more room to run, but those growth rates will definitely slow down as the years go by. All right, so let's actually look at the metrics and get an idea, get a feeling of Tesla's financials. So right here I have the 2025 Q4 presentation. Quarter over quarter, it looks like their automotive revenues declined 11%, and that makes sense. Lots of competition from BYD, Rivian, Lucid, Polestar. We have competition from legacy manufacturers, big push into hybrids by Toyota and some other companies. And so I don't think that the automotive revenues will really grow too much in the future. So it's been down 10% year over year. And you can see that it reached a high of 82,000 in 2023, but it's been declining ever since. On the plus side, we do see that the energy generation and storage revenue, though, has been increasing steadily from 2 billion to 4 to 6 to 10 to 12. That is staggering growth, 27% year over year. And it kind of matches the industry outlook for generation and storage capacity for 23%. So it looks like demand is keeping up with the capacity. Services revenue still also really small, but we do see that it is growing. That includes subscriptions, charging, related activities, compute capacity, all that stuff. So yeah, that's really good to see. The issue is, though, that since the automotive market is so much larger, what is that, 24 billion to 70? The automotive segment is more than double the other two segments for energy generation and storage and other services and revenue. And so, although this may be declining and these may be growing annually at around, let's say 22, 25%, even if those do grow, they won't really significantly affect the bottom line for years to come. So let's keep that in mind when we actually go into the valuation. The total revenues down 3%. Operating expenses are up 23%. No bueno. Income from operations down 38% year over year. And net income down 46%. Looking at the CapEx, they have increased, which makes sense. They're investing a lot, developing new capabilities, investing in their infrastructure. Looking at active FSD subscriptions, they're only cracking 1 million FSD subscriptions, which, I mean, isn't too bad, but it does have a lot of room to run. This number is promising, growing at 38%. I do find it interesting that in their mission overview, they say we are focused on bringing artificial intelligence to the real world through products and services like FSD, robotaxi, AI robots, but it doesn't really mention cars. And so, what I think that the car segment, stable, probably cooked, but they're going to transition to being an AI company, software company, and an energy company in the future. So, due to the transition, I think that cars will make much less of an impact on the bottom line, whereas software, compute, subscriptions, energy, and robotics will likely see Tesla pivoting fully away from cars. Maybe not fully, but in 20 years, I'm not exactly too sure. All right, so let's actually run the numbers. We're using the Truth in Numbers valuation platform, Smarter Investing, Zero Guesswork, to get a good idea of how much an investor should pay for Tesla if they are thinking of investing. And we are going to be looking at Tesla. So almost $1.5 trillion market cap, price to free cash flow insanely high, 233 price to earnings also insanely high at 381, whereas the cash flow per share is only about 176, and the diluted EPS is only about $1.08. So I mean, off the bat, very expensive, but we'll see if it's worth it when we run the numbers. Had pretty good free cash flow over the last 5 years, 15%, and pretty good diluted EPS, 35%. Good return on equity numbers. I think that is better than most car companies. Based on the investment, expected free cash flow is about 15 to 12%, which is pretty good. Pretty good. 5-year share growth is annualized. It is about 1% per year. So if you do invest, just keep in mind that you're expected to have 1% shared dilution. EV to EBITDA, insanely high. We'll see if the growth metrics actually kind of pan out and match. But we also have a high current ratio, and that looks good. It looks really good. All right, so let's just do this the easy mode. Um, Desired return, let's get an estimate of the fair value. Desired return based on the weighted average cost of capital, about 12.73%, so we'll just leave that. And we'll just use the expected free cash flow growth, and we'll just say that we expect that to be the growth for the next 10 years. The variance of 20, so that we can get our best case and worst case scenarios. And so we use free cash flow for that. And so the valuation that it returns, the fair value is only $23. That is quite the discrepancy from 380. So if you do think that the free cash flow will grow at around 15% for the next 10 years, yeah, current fair value is $23. Compounded return, so you're expected to lose about 16%. With a compounded price return, you're pretty much expected to lose about 16% year over year if this valuation matches future reality. We'll look at some more scenarios and we'll see kind of what the market thinks, what the market expects. This was just an easy mode, taking the stock inputs, and this is what we got. Fair value of $23. Expected compounded annual return, negative 16%. I mean, that is good growth. 676. Let's switch out of easy mode and let's actually put in a fine-tuned valuation and let's see what we get. All right, so the beta is currently at 1.8. I think that's a good beta for a car company. But let's just say that they switch more into AI compute, energy storage, software. Let's say the beta goes down to 1.2, and keep in mind Tesla, they have SpaceX, X, Starlink, robotaxis, Tesla Semi, all these companies that he's responsible for. And so a lot of people are really enamored by Elon Musk. And so we'll drop the risk premium to about 3%, and we'll leave the desired return based on the weighted average cost of capital around 13%. And expected risk-free rate 4.3. Let's just leave that and see what we get. So as we mentioned previously, industry growth is low for autos, 9%. Storage and generation, that segment was growing at roughly 27%. So that's really good. And then the robots are at 130. So let's just assume that these segments are growing a lot faster. Autos are stagnating just because of all the competition. And let's see what we get. Let's just say that the best case scenario, energy storage and generation grows like gangbusters, eventually overtakes the auto segment. They make more money through compute services, more people get FSD, robo-taxis are everywhere. And let's just say that the free cash flow grows at 35%. Pretty lofty, probably unlikely. And let's just say that they start a buyback plan where they buy back 1%. Let's set the terminal growth rate to 3.5, and let's keep that probability at 25%. Actually, let's set the terminal growth rate at 4%, and let's keep the probability at 25. For a base case, let's just say that it grows at around 25%. They also do buybacks of 1%, terminal growth rate of 4, probability of 50%. And the worst case scenario, let's just say that they only grow at 30%. Oh, wait, 35, 25. So let's just make this 20%. And they do aggressive buybacks with a terminal growth rate of 3.5 and a probability of 25%. Okay, so that really changes things. So we have a fair value of 288 and a compounded total return of 3%. I don't really know if they can achieve this number though. 35% is a lot to grow. 35%. So even in the even in the best case, you know, future cash flow grows to be $39 per share. That is impressive growth. 33%, 30, almost 37% when you factor in buybacks, and expected total return of 13%. Very, very lofty. Very lofty. Is it achievable? I don't know. I don't really think so, at least not in the midterm. Because again, autos are the largest revenue segment, more than double the two other ones, more than double their services and other revenue, and more than double the energy generation and storage revenue. Free cash flow growth. In this scenario, we expect that energy, robots, FSD, cyber, semi, robotaxis, all this takes into account, or all of this is taken into account, and it grows spectacularly. It's still not priced all that well. Terminal multiple, 32% once it kind of comes down. And it says, like, the fair value, if you do believe that this case to be correct, then it is technically below its fair value currently. It's only at 380. And so this is a compelling valuation if you believe that it can grow at 35. If you do believe it can grow at 35% annually for the next 10 years. I think the most likely case would be maybe the 25% scenario, but the expected total return for that scenario is only 2.5%. 2.5%. Fair value if you do believe that it'll grow at 25% with a standard terminal multiple based on, growth rate and everything, then you're only really going to return about 2.5% annually. And this is pretty impressive, you know? EPS, FCF growth at almost 26, 27% yearly, take into account buybacks. But I still think that that's pretty unlikely. All right, so let's do a couple more situations. And let's say that we expect interest rates to drop down to 3%. Also unlikely. Huge demand. Let's run it again. Then we have a more favorable return projection. It does give you a higher fair value, a higher, terminal multiple, and it also gives you a higher expected return for the best case scenario. 17%, that's nothing to sneeze at. That's a lot of money over the years. Even in the base case, though, in the base case, still unlikely, the base case for 25% free cash flow growth, the expected total return is only about 7%. And so if you believe that they can grow this much and you think that the 10-year yield will come down to 3% eventually, then by all means, it's fairly valued and you should buy it. But I think that the most likely scenario is probably that it grows at 20%. Best case, I do think that we may be in an AI bubble. Lots of investment going there. So I'll just put the risk free or the risk premium at 4.5. I know Elon Musk has been known to pull magic out of his butt. So I'll give him the benefit of the doubt. And I won't put it at, 5 or 6 for other companies. So we'll leave it at 4.5. Risk free rate 4. Base case, I'll say that it grows at the expected free cash flow growth. Let's just keep the terminal growth rate at 4 because I do think that it has a lot of room to run and it probably won't be growing. It won't stop growing once 10 years are up. All right, so 20% best case growth, 15% neutral growth, and worst case growth or free cash flow is at 10%. But they do aggressive share buybacks, and we'll keep the terminal growth rate at 4. Even so, the fair value is only $70. $70. So if you believe this case with all these inputs, 20% best case growth, 15% base case growth, and then 10% worst case with, pretty conservative, pretty conservative rate for the 10-year yield and a not bad risk premium, then you wouldn't want to buy this to get a desired return of 13%. You really wouldn't want to buy this at anything above $50, which is quite the discount. Quite the discount to what it's currently trading at 380. And so if I wanted a 15% return using these same expectations, then I wouldn't want to buy it at anything more than 41. So I know that Tesla is definitely one of the most polarizing companies out there. You have the richest man in the world doing some really impressive stuff with energy storage, pretty much created the whole EV segment, lots of competition, but lots of room to run. Personally, I wouldn't invest in Tesla. I don't know if I even believe that they can achieve 20 or 15% free cash flow growth or earnings growth over the next 10 years. I know that they have some really promising segments, but it's a little bit too far-fetched. And even if they did hit these numbers, fair value is only 114 to 62. It would have to come down by almost 2/3. It would have to come down by almost 2/3 for me to even think about buying it because it's so expensive. All right, well, that's about it. What do you guys think? I know there's a lot of Tesla investors probably watching. Leave comments if you think that I missed something. Also, if you want to invest in Tesla, I definitely recommend you checking out truthandnumbers.app. That's truthandnumbers.app. We take the guesswork out of investing. Sign up, get started for free. We take the guesswork out of investing so you can actually stop guessing, start valuing, and make some money in the stock market. You don't want to be buying super expensive, overhyped stocks just because someone recommended it on social media, Twitter, or on like a Discord chat room. With our platform, you caught some mistakes, you strip away the market hype, and it gives you precise buy targets based on different scenarios, and it also shows how much you can expect to make yearly based on our leading model. Protect your wealth. Stop overpaying. Get started for free. If you sign up, you get 4 days free, completely risk-free. And you can cancel anytime. Right now, we're running a sale on the yearly plan. Only $120. If you use this app for more than, 10 times, you will definitely make more than $120 a year. So it pays for itself. And we're also offering 6 months free, no price increases, and a full refund if you go past the 4-day free trial and you're not satisfied for any reason. So no reason to not do it. And if you want to just, dip your toes, we also have the monthly plan. Also comes with the same 4-day free trial. You can cancel anytime. All right, with that said, I'll see you in the next one.